Welcome to Rebel Investment Management. Today, I will be talking about two nanocap stocks that I see huge potential in. Now, if you don't know, nanocap stocks are typically defined as companies that have a market cap of below $50 million. I usually try to invest in stocks with a market cap of below even $10 million. And the reason is simple. Most of these companies are not covered by any institutional investors or analysts, and that means there's a lot of opportunity for mispricings. If you can find a diamond in the rough at this level, it can run 5x, even 10x on very little news once people are made aware of how cheap the stock is actually trading at. I am a value investor, and as such, the daily movements of stock prices is not what I base my investments on. I base everything off of potential future earnings, what the management is doing, as well as fundamentals like book value and enterprise value. So let's get straight into it. The first stock is Express Inc., ticker symbol EXPR on the OTC market. This stock is what's regarded as a Benjamin Graham cigar butt. This is where you buy stocks of struggling and distressed companies at prices lower than the intrinsic value of the company and then sell as either the company liquidates or the mood around the stock shifts to a more positive tone. Express is an apparel and accessories brand founded in 1980 that operates almost 600 retail and outlet stores in the US. Trailing 12-month revenue is $1.79 billion, although it has been falling gradually in recent years. 2016, for example, the revenue was $2.19 billion. That's about an 18% decrease in 7 years. Operating income has also been taking a big hit since COVID. Trailing 12-month operating income is minus $185 million. The company hasn't been profitable since 2018, when it had operating income of 108 million, 54 million, and 28 million from 2016 to 2018. Now, the company is clearly struggling and is in deep trouble. Bloomberg have said the company might even file for bankruptcy as soon as this week. But the company has hired a debt restructuring firm to see if they can stay alive by restructuring the 280 million of debt that they have. Now, the balance sheet actually isn't too bad, with 1.56 billion of assets and 1.25 billion of liabilities. That gives a book value of $307 million. The current ratio is 1-to-1, which isn't great, but it could still be a lot worse. Now, this is a company that is reportedly teetering on the brink of bankruptcy, but based purely on the numbers and how big of a name Express actually is, I still think it has a chance to survive. The company have not made any official announcement on bankruptcy, and they're still posting jobs they're hiring for online, even as recently as yesterday. So yes, this is a company close to bankruptcy, but it is a retail giant with 600 stores, almost 2 billion annual revenue, and a book value of 307 million. What do you think is the right market cap for this company? I'll give you a second to think. Now, if you said anything above 2.5 million, that means you think this stock is undervalued, because that's exactly what the market cap is, just $2.5 million. The stock is at 66 cents per share right now, and it looks like bankruptcy is priced in as a 100% probability. If a bankruptcy announcement is made this week, I don't really see the stock moving at all, especially given the book value of 307 million. On the other hand, if the company comes out with any news that isn't the worst case scenario bankruptcy, I can see this shooting up 2-3x at least. I don't recommend putting a large portion of your portfolio into this, as there is still a large possibility of bankruptcy, but I'm willing to take the risk with about 2% of my portfolio, because the rewards here will be massive if this doesn't end in bankruptcy. The second stock I want to talk about is Quoho, ticker symbol QH on the Nasdaq. It is a gig economy platform based in China. The company operates in industries like food delivery, ride-hailing, housekeeping, and bike sharing. The company's revenues have grown from $96 million in 2017 to $625 million in 2021 and have stagnated since then with revenues of $523 million in 2023. Its gross profit margin is very small at 4.5%, as that's the percent of profit they make from each gig someone's hired for. Operating expenses have fallen from $40.5 million in 2021 to $27 million in 2023. So this tells us their operations are becoming a lot more efficient. The Chinese economy has been in a downturn recently, but that's eventually going to turn around at some point. And when it does, I could see Quoho's revenues returning and exceeding that of 2021. A revenue figure of $700 million, which the company was well on track for before the downturn in the Chinese economy, gives a gross profit margin of $31.5 million, an operating income of $4.5 million. Once the economy turns back up, the company will get back on course in line with the previous revenue growth, which would suggest a high PE multiple. But considering the Chinese economy isn't doing well right now, let's suggest an extremely generous PE ratio of just 15 times these potential operating earnings. That suggests to us a company with a market cap of $67.5 million. The balance sheet looks very good right now. The company has $146 million of assets and just $74 million of liabilities. The current ratio is 1.5 to 1, which is solid, and the tangible book value is $50 million. So now again, I'm going to ask you to come up with your own market cap figure for this stock, given all this information. I guarantee you didn't say $4.5 million. The margin of safety here in this stock is huge. The only one thing I would be worried about is the management does seem a bit sketchy, and microcap Chinese stocks are known to be often very fraudulent. This one, to be honest, doesn't jump out to me as a fraud straight away, but you can never be 100% certain of anything, especially in the stock market. So I would urge you to do your own due diligence, but I'm in here for a small portion of my portfolio. So that's all from me today. Thank you for watching, and I'll see you in the next video.